Welcome to another episode of Retirement with Rick. I'm your host, Rick Rodriguez, and today I got a special guest to help us take a deep dive into the complex world of retirement planning. A very special one, Gerard Ladalardo.
Thanks for having me, Rick.
You betcha. Gerard is a U.S. Marine Corps veteran and a managing member of Legacy Financial here in Las Vegas. As an income and asset protection specialist, Gerard helps retirees and families create dependable retirement income and protect their asset from risks like taxes, market downturns, and long-term care expenses. In this episode, we're going to talk about how all the key areas, Social Security, taxes, Medicare, estate planning, and even home equity are connected. Whether you're retired, nearing retirement, or just want to understand your options better, you're going to walk away with some valuable ideas to hopefully improve your plan and protect your future. So Gerard, welcome to the show.
Thanks for having me, Rick.
First and foremost, being a U.S. Marine veteran, thanks for your service and of course all that you've done for our country.
Appreciate that.
That's always an honor to have someone who served on the show. So thanks for that. Speaking of that, I'm sure that your experience in the military has made a big impact in your life personally, also on a business side as well. How has that experience kind of shaped your approach to how you work with your clients and just how you run your business overall?
Well, first thing I'll say is once a Marine, always a Marine.
Yeah.
So I think for me, as a Marine, as a young Marine, we're taught Marines we never quit. Yeah. Never, ever quit. You figure out what the problem is, you solve it, and things were a little different when I was in because Marines just destroy it, go through it, destroy it, whatever it is. In business now, I have to take a little bit of a different approach, but having structure, having structure, details matter, discipline. I think these are all things that, has kind of shaped me from being a young man to as I grow older, in everything in life, and having just set a plan and get it done.
Yeah, sure. And with what you're doing now, helping families plan for retirement, what aspect of that is what gets you up out of bed every day that really just, fills up your cup, so to speak?
I think for me, there's very little education out there.
Yeah.
I graduated high school in '86, and back then, they taught us how to drive at 16, which is probably par for the course back then, but they're still doing that now. Instead of giving these kids what I would just sum up as the good, the bad, the ugly about finances. Whether you go into the college, you go in the military, you go in the workforce, you learn the hard way about finances. So I think a big part of it is the education part, because now the internet sometimes is good and bad for that.
Yeah.
10 years ago, you plug something into Google, you got an instant answer. Now there's all kinds of ads and deceiving this and that.
Yeah.
But for me, it's the biggest part is education. So people understand where they're at, what the problem is, and how we can fix it.
Yeah, sure. That makes sense. And if you weren't doing what you were doing, is there something else that comes to mind that maybe you'd be doing if you weren't in the finance industry?
I honestly don't know.
Yeah. How long have you been in the finance industry?
Probably, so I was in mortgage for like 14 years, starting in 2000.
Okay.
So since about 2000, actually before that, when I got out of the Marine Corps, I was selling life insurance through Prudential. And then I was doing something else, and then I got into mortgage about 2000. So 25 years now.
25 years, yeah.
Yeah. And I love it. There's always things to learn.
Sure.
Even as professionals, we learn stuff. But just the fact that the education that we know to help ourselves and our families and friends and clients is a big deal. But the education part, I feel, is not out there. And, any way, that we can educate clients. Sometimes I do live workshops, the local libraries and stuff, and educate clients on taxes, Social Security, estate planning, RMDs, which are required minimum distributions.
Yep.
A lot of people have no idea about how all this works. And, 30 years ago, it was pretty simple. You went to work for a company, you had a pension, Maybe you save some money on the side. Now it's so different and complicated.
Sure.
I think only 18% of people have pensions now.
Right.
And then you got to figure it out. And it's very complicated. As you mentioned before, one thing can affect the other, and people don't really understand that.
Right. Yeah. With all this education, what is there any lesson that for you personally that stands out that maybe you wish you would have learned sooner? Anything that
Yeah.
Yeah.
Start saving as soon as possible.
Yeah.
Saving, maybe if you're young and, a 25-year-old and you're married and you have a kid, get life insurance. The old saying that having a baby is never the right time.
Right.
Kind of the same thing. Just even if it's $50 a month, start saving. $50 a month, $100 a month. Put some money aside for, a rainy day, emergency fund. But just and start getting some of the education. Start seeking some of the education about, saving for retirement, protecting your family and stuff. So
Yeah, sure. I've heard you say that there's all these moving parts in retirement that are connected, and how there could be really a ripple effect. And you just mentioned a minute ago too. I mean, things are more complicated than they were 30 years ago for people who are working and trying to save. It was, not as many options maybe, or maybe it's just a simpler time as well, So now it's with this complexity. Give us an example of how like one decision in retirement can maybe have a ripple effect to all these other areas.
So I see a lot of videos on YouTube about when is the best time to take Social Security.
Yeah.
And it's kind of ridiculous because it's a personal decision. So for example, I'll talk to a client, and if they tell me, let's say it's a woman and she's like, every female in my family history for the last 100 years has lived over 90 years old. Well, then you probably want to take Social Security later because there's a line that's crossed that you'll get more money lifetime. But we have software that'll figure that out. And then on the reverse of that, if I'm talking to someone and maybe it's a male and he says, there's never been my grandfather, my father, my grandfather, my great-grandfather, no one's lived past 70, then start taking Social Security early. But it's a personal decision. It's also based on your finances. So like if someone goes to retire and they've got enough money for retirement, why would you take Social Security and have extra income, possibly putting you in a higher tax bracket, maybe paying more money in taxes? It just doesn't make sense. One of the other things is 96% of people actually take Social Security at the wrong time.
Is it 96%?
96%. And so that equates to $111,000 of lost income over lifetime for Social Security.
And I'm assuming, is that typically that they're taking it too early and they could have waited a little bit longer, or is there more to it?
It's just they're taking the wrong time. So,
wrong timing.
Yeah, the wrong timing. So another example is for people who are 62 and older and they start working, because you can take Social Security, you can start at age 62.
Yeah.
And let's say they're working, there's penalties that the Social Security Administration, if you make more than $23,400 a year, which is not a lot of money, if you make more than that and you're taking Social Security at the time, they'll penalize you $1 for every $2 you're over. So, for example, I've had clients come to me; they've had $20,000 or $30,000 penalties. Now, you can pay that back within a month, and then your Social Security payments continue to keep coming.
The full penalty, you'd have to pay the full penalty?
You have to pay the full penalty, and if you can't pay it in 30 days, well, let's say you owe $20,000, they won't pay you until you get to that $20,000 mark, and then they'll resume your Social Security payments. But for people who don't know that and they rely on Social Security, that could be detrimental to their income.
So obviously, you're saying at the onset here, I mean, there's the lack of education.
Yeah.
Right? People not knowing, not digging into this, maybe not having someone like you on their side that can coach them through this. But hold on, before we pull that trigger, let's look at all these moving parts to see if it's going to make sense. Yeah. What a shame. How many people, I assume a lot of people then get into it and then they don't have the money to pay for that tax. And now
most people don't.
Most people don't, right?
Yeah.
Yeah. That cap that you mentioned, just out of curiosity, that $23,000 cap, has there been talk about? I mean, that's very low. Like you said. I mean,
It goes up every year.
it goes up, but
Less than, I think, maybe $1,000 at
that
most.
thousand at
Yeah.
most.
Yeah.
Do you feel like it's outdated with today's current income and inflation and levels and?
It is. But think about, Social Security was enacted in, God, I forget what year, 1913 or something. And when they did, the system hasn't had many revisions in the last 100 years. So the problem is when they started Social Security, you were supposed to take Social Security at, I think, at age 65, and the average, or maybe, no, 62, but the average lifestyle was 64 or 65. So they really didn't expect people to live more than a couple years. And now, we'll talk about this later, but
Yep.
when people retire, there might be 20 or 30 years that they have to live past Social Security. When they first started Social Security, they weren't planning for people to live that much longer.
Right. Right.
You know,
Right. Yeah. With this being said, I mean, obviously, there's a need for education, especially in the area of retirement. I mean, like we said, so many moving parts. What's your process in helping clients to create more income or maybe salvage more income in today's environment?
so the first thing is I'm independent. So
Okay.
I'm an independent advisor, meaning that I don't work for a specific company.
Okay.
So I contracted with like 50 different A-rated companies. Excuse me. And so whatever the best product and the best company is for my client at the time, that's what I use. Because I feel that there's no way possible one company can have the best product for every person out there. It's really impossible.
Okay.
Okay, so I start with that, and then it starts with education. So I need to have a complete financial, let's just say a financial account of their finances and their goals, see what their goals are for retirement, and see
Yep.
if they're realistic. Sometimes people have that champagne retirement on a beer budget,
Yep.
and then we really have to have a hard talk, And once we figure that out, then we can start figuring out the sources of income, how long they have to work, how much money they'll have at retirement, how much they can spend, because a lot of people don't know that. A lot of people, all they're doing right now is they're putting money away in IRAs, 401ks, their brokerage accounts, but they're not understanding that at some point, all these pieces have to come together and you have to start strategizing how to withdraw money in the most tax efficient way.
Right. Sure.
And so that's really where it starts. And then, like I said, I get people that come to me sometimes. I had a guy, the last workshop I did, he just retired. He was 64. He had $1 million in his 401k. His house was paid off. He's frugal. That's his words, not mine.
Yeah.
And he had a $5,500 pension, and the only bills he had were recurring bills like electric, gas, cable, and he had no idea if he retired, but he had no idea what the plan was. And so we put together a plan so he knew he would not outlive his income, that he had X amount of money he could spend. And then if he was doing anything like buying a new car or taking trips, we would add that into the budget and put a whole plan together. And then he had a complete plan, because the problem in the industry today is, and I used to do this myself, was sell what I call pieces of the pie. So if someone needed life insurance, I sell them life insurance. They need annuity because they wanted to protect some money, I'd sell them annuity. They wanted estate planning, I get them an estate plan. Now, and the problem with that is these individuals don't work together. So if you go to a bank, they're going to sell you bank products.
Sure.
You go to an insurance agent, they're going to sell you life insurance or annuity. And if you go to a broker, they're going to try and sell you everything that they have on the stock market. They don't work together, okay, and try and figure out what works together. Because sometimes, they're all important pieces, but depending on where you're at in life, one will have more precedence over another, as far as importance. And they don't work together. This is why I started about 2 years ago doing like holistic planning, doing more of an entire plan. So people have an entire plan that enabled, them to see when they can retire, how much money they'll have for retirement, how much they can spend, will they or will they not outlive their money, and then preparing for things like long-term care.
Yeah. I think this is such an important part that people need to understand. And I want to just elaborate on what you just said a little bit further. And that's the fact of, a lot of people just go to maybe the safe place that they know, which could be, like you said, their local bank to help them with retirement planning matters. And is the bank going to have more of a holistic approach versus the difference with working with someone who is managing their own practice? And I want you to elaborate on this for a second. The difference with individuals in your position versus other individuals, advisors, that is, who maybe are working for big box firms and have this, line in the sand that they are constricted on what they can and cannot do, what they can and cannot offer, and how that trickles down to the consumer.
So that's a great question. For me, I don't knock other advisors on how they do their business because everyone has their own system, their way of doing things.
Sure.
But I feel that as a financial advisor, I feel that it's my job to protect my client every way possible. So not only working with them to put a retirement plan together, but talk about long-term care, talk about things like an estate plan. If they've got assets, they've got a spouse, they have a house, they got grandchildren, and they've got assets, they want to come down the line, a succession, that without going to probate and stuff, then they should have an estate plan. There's also risk mitigation. So that's a very misunderstood topic because most people think protecting their money in the stock market, but that's not it. So think about people who work hard, they're making money, they've got a home, maybe a second home, a rental property, any of these things. They got children, they got teenage drivers, they got a boat, RV, a brokerage account, a business, and one lawsuit can take everything away. So if they're not properly protected, they can lose everything. So perfect example, you got a teenage son, 17 years old, they got a house on the lake. Take a few friends out in the boat, and we were all that age once. Sometimes drinking gets involved and maybe someone gets killed. Okay. Now, if you have that boat in protection of an LLC, better off a Wyoming LLC, now they can only kind of sue the LLC. They can't come after all the other assets. So that's what I'm talking about, risk mitigation. I think that, I'm not held in that box, but I am a fiduciary, which is held to a higher standard.
Sure.
So I think those firms, when people work at those firms, like you said, they are boxed in sometimes what they can do, but it's not really the advisor's fault. And I'll give you a perfect example. Yeah. Most of those firms, they hate annuities. They hate what I do, life insurance and annuities, because they can't sell them and make constant money on them. If I sell a life insurance policy or an annuity, I get paid once. And there might be some very small trails on that, but very, very insignificant. What people need to understand is there's a place for both a brokerage account and the other things like annuities, life insurance and stuff. But when they manage your money for 20 or 30 years, that's an income for 20 or 30 years. So whose best interest do they really have? So, like I said, I just do what I can do and I do what I feel is right for my clients. And like I said, I just try and protect them in any way I can.
Yeah, sure. Talking about taxes, are there any tax surprises that you see retirees often run into? Things that just kind of catch them off guard, whether before maybe they come to work with you, or maybe sometimes in the process if they're not adhering to everything that you're laying out for them. Are there any things that stick out?
I think the biggest thing is RMDs.
Okay.
So most people don't know what that is. It's required minimum distributions. You used to have to take them at at age 70 and a half, and then they change it to 73. And if you're born after 1960, like you and I are, you have to take them at 75. And so the problem with that is I see people keep dumping money in these qualified accounts. Qualified accounts are IRAs, 401ks, pensions, TSPs, everything that you haven't paid tax on yet. And the government designed it this way. So think about it. You work for a company. I know this is not realistic today, but you work for a company for 30 years and you put into a 401k for 30 years. So say you put 300,000 into that 401k. You never got taxed on it yet. Why? Because when that grows to 1.5 million, when you retire in 30 years, now the government wants to tax you because they don't want to tax you on 300,000. They want to tax you on 1.5. And the problem I see is a lot of people who've done financially well and maybe they don't need that money. They want to leave it as what we call a legacy, so to pass down to their family. They're forced to pay RMDs, required minimum distributions. The government forced you to do that. And whether you want to pay them or not, whether you need them or not, you have to withdraw that money and pay tax on it. And then, that sometimes puts people in a higher tax bracket. They're paying more taxes, and now they're also depleting money from that account. And so it kind of defeats the purpose. A lot of people have no idea that this huge tax bomb is coming.
Yeah, right.
So I try and separate. I'll talk a little more about that, but
Okay.
try and put people in different tax brackets, or tax buckets.
Okay. Okay. You mentioned a little bit ago too, long-term care and something I've seen too. I mean, that's a real risk for a lot of Americans right now. I'm sure you've seen more stats than I have on this, but I've read stats where maybe 78% of us are going to need it one day, but there's only about 5% of us that have it. So a very small amount of people who have long-term care coverage, but an overwhelming amount of people who are probably going to need it someday. What's your take on planning for long-term care without necessarily draining retirement assets?
Great question. So long-term care, I think, is one of the biggest killer of retirement plans. And you're right. I think it's less than 3% of people buy long-term care plans now. A lot of companies have got out of business doing it because you pay for premiums your whole time, and then if you don't use it, you lose it, right?
Yeah.
And then the premiums keep going up every year, kind of like almost everything else. But you think about today, like in the state we live in, long-term care in a facility is about $70,000 a year. Now, I grew up in New Jersey. I bet it's another 30% higher than that. Think of like states like Connecticut, New York, New Jersey, California. It's significantly higher. And when you take, let's just say 70,000 today, when the average male could be in a retirement home or in a facility for 2.5 years, and a woman, I think, is 3.5 years. Take that 70,000 today, what is that going to be in 15, 20 years when they need it? In 20 years, it'll be about double. So you figure 150,000 for a couple, that's like over $700,000. And majority of Americans don't even have that much money saved. And the sad thing is they think that Medicare is going to cover everything.
Right.
Medicare covers skilled facilities, not unskilled. Like if you're home and you have assistant coming in and helping with your family stuff, that's not skilled. So they don't pay for that. Medicare only covers 100 days. So that's the biggest retirement killer. Now we have hybrid, they're actually annuities, hybrid long-term care plans. I'll give you a perfect example, and they're phenomenal.
Okay.
So let's say someone applies and they put $100,000 in one time and they're healthy, they can double their money or triple their money. And usually if they're pretty healthy and up to age like 75, so someone puts in 100,000 and they get approved within 2 weeks, now they have 300,000 towards long-term care. Where else can you triple your money like that?
Yeah.
You can't. And then the base starts growing, okay, typically of 5 or 6%. So if you don't need it in 12 years, it's not 300,000. It might, be significantly higher than that. And the beauty is also now, if you don't use it, you don't lose it. So it's a beneficiary driven product. If you pass away and never use it, that money goes to your beneficiary. So they're pretty phenomenal products. But long-term care is one of the most untalked about things in retirement, and it's literally the biggest retirement killer.
And obviously, where does it get people? Where does it quote unquote kill them? I mean, at the point where they're having to go to a facility and they just don't have the money, they therefore don't get the care, or for those who do have the money, it just ends up wiping a large part of their nest egg.
Yeah, both of those. And when you look at most Americans have probably less than $500,000. I think is that the numbers are actually lower than that.
Yeah.
Being in a facility for 2 or 3 years could be hundreds of thousands of dollars and literally could destroy their, think about this, a typical man 10 years older than the wife, and he goes into a facility and it wipes out or takes a huge chunk out of their retirement income. Now you just left your spouse kind of high and dry.
Right.
How
many cases like that must happen?
We see a lot.
Yeah.
We do see a lot.
Yeah.
Yeah. We're trying to help prevent that
Sure.
by educating people and getting them in these plans and having a roundabout plan. But, sometimes people are kind of hard to accept. It's one of those things, just like reverse mortgage, right? I think it's kind of like leasing a car. Not the best for everyone, but for the right client, it's an absolutely phenomenal product.
Right. Right. I mean, that sounds like getting into next question here. I mean, that sounds like one of these basic estate planning tools or products that maybe should be in place. But with that, what are, in your opinion, what are some like basic estate planning tools or plans that should be in place for every retiree?
So I always tell people, if not everyone needs an estate plan, but everyone should have power of attorney for healthcare and for finances.
Okay.
If they do need an estate plan, let's say they have a house, they've got a spouse, they got kids, grandchildren, brokerage account, a business, they have assets, they might want to have it's probably beneficial to have an estate plan so they can pass that wealth down to their heirs the way they want to without having to go to probate.
Right.
There's a big misconceptions in the public about estate plan. A lot of people think if they have a will, they're okay. It's not okay. If you have a will, everything you own is going to probate. Yeah. And so I try and explain to people that you actually have a plan, you don't know it. And the plan is the government's plan. It's probate. And if you don't do anything about it, everything you have goes to probate. It's public. I had a client in California 2 years ago, 3 years ago. This is how I got into the estate planning to educate my clients on it. So long story short, her mom passed away a couple of years before that. The dad bought a really nice house. They were fairly well off, but the dad bought a $500,000 motorhome after the wife passed away, and he did some traveling and became more friendly with his neighbor. His neighbor would go on trips with him because his wife was gone too. And when the father didn't have any plans, no estate plan, he passed away, a heart attack overnight. His estate went to probate. And when your estate, like I said, goes to probate, it's public. And so anyone public can go to that probate and plead to the judge. And this guy pleaded to the judge, so-and-so and I went on these trips. He wanted me to have the motorhome. And what happened was, the judge ordered her, this is her father's motorhome, ordered her to sell it and split the proceeds with the neighbor. Wow. That is insane. And so the other thing is, I don't know if you remember the Terry Schiavo case in Florida.
I remember the name. I forget the details.
35 years ago. It's insane. So what happened was she was mid-20s. Mm-hmm. I think she was dieting or something, and she ended up having some type of fall or something. She had no oxygen to the brain. They brought her to the hospital. I think at that point she had like 8 minutes with no oxygen. The husband shows up. Hey, doc, I'm the husband. I know my wife's beliefs. I know she doesn't want to be on a respirator, which she was. And the doctor said, do you have power of attorney for healthcare? He said, no. Doc said, sorry, by law, I can't help you. If you remember that case, he wanted to pull the plug because he knew his wife's wishes. The family didn't want to pull the plug. And so I can't believe this. I had to look this up, but she stayed on life support. I thought it was 8 years. It was 15 years. She stayed on life support. And the end result was a huge lawsuit, millions of dollars spent, a family torn apart, and the only ones that win were the attorneys who made all the money. And I always tell people, is this what you want to put your family through?
Right.
It's easy way to not put your family through it. That's why it's so important to have powers of attorney, power for healthcare, and such.
Yeah, great point. Great point. Yeah, I mean, I see that a lot in my practice too. Not that I have to dig real deep on every case, but I see when people have trusts or don't have trusts, and majority of people I deal with don't have their home in a trust and don't have a trust. So I presume that maybe they don't have even, power of attorneys in place for one another. So that's a great point.
Yeah. The other thing is they should have a homestead.
Yeah.
Like here, I think it's 605,000.
Yep.
I think it is. Their home equity is protected.
Yep.
Most people don't know what that is.
Right.
I try to educate them on that. And it's different in every state. Like my state, I grew up in New Jersey. I think it's one of the states is like $20,000. It's useless. $20,000. What's it gonna do?
Right. Sure. Right.
Yeah.
Here's definitely worth it. You're right.
Yeah.
Pivoting to housing wealth, something that I kind of work in that space with what I do and what our company does. You touched on it a little bit, but just always like to get your thoughts. What are your thoughts on a reverse mortgage being used in the retirement plan?
So first thing is, I think it's a very misunderstood product. I think there's not enough education out there, and it's one of those products that gets looped into like car leasing, timeshares,
Yeah.
Et cetera. And I think that, like I said before, I think they're a great product for the right client. And reverse mortgages, as you know, because you do them, they've really evolved over the last X amount of years. And I think for the right client, the right timing, I think it's an absolute great option for them. But it's not my specialty; it's yours.
Yeah.
So, but I'm a big believer in them.
Do you think there could be some solutions to some of the problems we've talked about, like not having proper funding for long-term care expenses, maybe even some strategies with paying RMD taxes when the time comes? Have you seen or have any thoughts on maybe utilizing this tool in some of those types of strategies?
I haven't thought about it, but that's a great question. I think yes. It's every now and then it kind of strikes me odd when you have someone who's paid off their house and they have equity, complete equity in their home. They're living off Social Security. They're absolutely broke.
Yep.
And they're not living their best life.
Yep.
And all they care about is passing on that asset to their kids. And I always say good kids will not care about the asset. They want their parent, just like our mom.
Yeah.
Our mom's concerned. My mom will turn 80 this year in September.
Okay.
And my mom, all she's concerned about in New Jersey is passing on the home. We're like, Mom, she actually lives a good life. Sometimes she's out more than we are.
Yeah.
She has a good life. But we try to tell her, Mom, enjoy your life. Spend the money. She doesn't have a reverse mortgage,
Yep.
but she's got a lot of equity in the home.
Yep.
Mom, spend the money. Enjoy your life. We don't care. We don't care what we get out of the house. We want you to have a fulfilling life.
Right.
And good kids will understand that. And so to answer your question, I think it can solve the reverse mortgage, as you know, can solve a lot of these problems.
Yeah.
Just the big part of the problem is getting the education out there so the public can understand.
Right.
And kind of let that wall come down that, whoa, reverse mortgages, they're not the devil. They're actually a great product for the right timing.
Right. Right.
So
Yeah, well said. Medicare, we know that that's a complex area. And I'm sure there's a lot to it, but if you could leave us with a couple things on Medicare that you would want retirees to understand about the costs involved and how income can affect the premiums on Medicare.
So Medicare premiums depend on your income.
Okay.
And one thing I'll tell you that I've come across a couple times is I had a client just 6 months ago. He was referred to me. He retired a year ago, and before he retired, so he's making about $100,000 a year before he retired. He took out $400,000 out of his 401k before he retired to pay off his mortgage, which seems like a great idea. And the end result, the numbers probably work out better that he did that. However, what he didn't know was Medicare has a 2-year look back. So if you turn 65, you retire and you get on Medicare, they don't look at your income today. They look back 2 years from today.
Okay.
And so what happened is they took his $100,000 of income plus the 400 that he took out because he had to pay tax on it, right?
Yep.
To pay off his house. And now he had $500,000 income. And so his premium went from, now they just changed it. I think it was 170 something. It's 185 for Part B now.
Yep.
But his Part B went to something like, the max is, I think it's $628 a month. His was close to that. And the thing was that's difficult about it is that stays that way for 2 years. So not only did he pay an extra like $400 a month for Part B, he's married, so he had to times it by 2. So it was a huge extra expense that they weren't counting on. They didn't realize because they didn't have the education.
Right. And then you said that's in place for 2 years. So once you get to that 2-year mark in the future, what can you do about that?
So what I always tell people is don't think that they're going to come knocking on your door, right? And expect that they got your date, August 5th, that they got your date there that they're going to reevaluate your income. I always tell clients, be proactive, months ahead of time. Make sure that they understand that this was whatever the situation was is not the current situation.
Right. Something out of the ordinary.
Yeah, income has changed.
Okay. So then they can go back to Medicare and have them reevaluate for those preceding 2 years and then they'll recalculate the premiums at that point. And can you continually do that? Is there a limit on how many times you can go back to Medicare and have them recalculate the income?
That's a good answer. I don't know, but I'll tell you this. I think people, when they make the mistake once, they don't make it again.
Yeah, sure.
Right.
Like many things in life. Yeah. That one could burn. Talking about legacy planning, college planning, how do you help retirees balance their own needs in retirement with wanting to maybe help their kids or grandkids with different expenses, maybe things like college funding? I've seen that a lot with a lot of my clients, who have grandkids. That's one of their objectives in retirement is I want to help my grandkids get through college. How do you help them balance?
So one of the biggest mistakes, I don't have kids. I never had kids. So for me, I can only guess, but I see a lot of clients that want to do the best for their kids and they want to pay for everything for their kids.
Yeah.
And the thing is the biggest mistake I see, these people are typically 10 years away from retirement, maybe 15 at the most, and they're paying this whole entire college bill instead of putting money away. And the problem is when they get to retirement, they don't have as much retirement as they need or they should have or want, and then it's too late because they never come back to their kids and say, hey, can you send me $1,000 a month or whatever it is. It usually doesn't happen that way. So I try and explain to clients, like, it's great if you want to help your kids. Let's look at a feasible plan so we can manage your expectations for retirement.
Right.
So that's the number one thing. You might laugh at this and the audience might laugh at this, but sometimes I get people to say, we can't save for college. We're putting money away, blah, blah, blah. And, I tell them, have your kid look at the military. And I'll tell you why. Because if they go into the military and they get a guaranteed job, like I went in the Marine Corps, I was ordnance. We work with bombs, rockets, missiles, small gun ammo, all that stuff. No one's really going to hire you we'll put it this way. When you get out of the military and you're a bomb expert, there's not many places looking to hire you, right?
Yeah.
But if you go in and you do something like Intel, communications, stuff like that, they do 20 years. So they get out at 38, they have a good job. Now they've got a pension, they got medical, dental for the rest of their life. And then at 38, now because it's a good career, they get into a second career in that field.
Right.
And it's usually a higher paying job.
Right.
So now they do another 20 years. By the time they're 60, they've got they're retired, 2 pensions, and most likely some disability, which is tax free.
Yep.
They'll have Social Security in the future, and they got medical and dental for the rest of their life.
A great point.
And when you think about having multiple sources of income, guaranteed sources of income, the only thing I can tell you that would be a better option is become a business owner and be super successful. But we know there's no guarantees in that.
Yeah, sure.
So I know that was a little bit off topic there, but people laugh sometimes I bring that up, but it is a great opportunity.
That's great points.
A lot of the guys I know that are retired now with a second job, I mean, they're making $16,000, $18,000, $20,000 a month just waking up.
Right.
And they did their time. They
Sure.
deserve it.
Sure.
You know?
Yep.
So
Yep. No, great point. I know we've talked already about some common mistakes that retirees have made. Are there any, and there's a variety of them, so there may not be just one solution, but just curious, is there any simple step that comes to mind that people could do today to get back on track?
first thing I would say is take a look at their finances. You know,
Okay.
people are so busy today that they rarely take time. Like I look at my bank accounts every day. And it's funny because probably once a month I see something on there like, what is that? And then I got to go back to the bank. And so I'm very controlling of my finances.
Yep.
And so I know what my expenses are. I would say the biggest thing is start taking a look at it. What are your expenses? Where is your money going? If you're getting $5 Starbucks every day, but you got 3 kids and no life insurance, there's a problem there. So I would say people have to really take a look in the mirror and look at what their situation is if they don't really understand. And a lot of times it's unknowing. When I was 44, I was managing a bank, about 25 loan officers at the time, making really good money. And I lived in California at the time. And I went in for a physical and a blood test, and I ended up getting diagnosed with an illness from the VA. And 3 years in the Long Beach VA hospital, in and out, in and out, in and out for 3 years, constantly. I had no income, and I had no idea. I was 44 at the time. It just hit me like a freight train, like standing on the tracks. But I had no idea of ways that I could protect myself, my family. And it was pretty devastating on finances. And I had to climb back out. And at 47, you can imagine how terrifying it would be to get back into business. And I had to be in business for myself. I mean, you can't go back in the corporate world at 47 having no history for the last 3 years.
Right.
So I think getting with someone that can take a look at your situation and help you understand where your plan is working and where it's not working, what you're missing is important to figure out. Because the longer you go without doing that, and bad things can happen, because I can tell you it happened to me. Now I'm healthy now, but I learned a pretty valuable lesson. And one of my biggest things was when I was a loan officer, and of course you're a loan officer, you understand that a lot of times when I was qualifying people, I would see people that, we're going back 20 years ago, they were buying bigger homes, new homes, and they really didn't need to. These were people 55 and 60 where, as you know, it's kind of a red flag to go from a 2,000 square foot home to a 4,000 square foot home at 60.
Yeah.
Now, if you're 30 and you got family growing, it's not a red flag. So it's just people really need, the biggest thing I think out there is just people need the education and understanding,
What do you think holds people back from either, you know, looking into this, sitting down with someone? Is it money? Is it they're too busy to look at their own personal situation? I mean, I know some professionals that, consult others and do a fantastic job, but when it comes to their own personal situation, a lot of them fail at that because I guess they just don't devote the time
Yeah.
for themselves. I mean, what do you think is a reason why people just don't take the step?
I think there's a million reasons today.
Yeah.
People are so busy. I mean, think about people with families. They've got
Yep.
kids in school. They're
Yep.
driving them to school and back now instead of, more majority of people aren't taking the bus.
Yep.
They've got fencing, band, soccer, baseball, basketball, all these sports, karate, all these things that are keeping people busy. And as you know, most people don't work a 40-hour work week anymore. They're working longer hours. So I think it's a combination of a lot of things. But I think most people just push the can down the road. I'll get to it. And sometimes, they're lucky if something doesn't happen before they take care of it. But I think there's a million reasons why people just don't say, I need to get this done. But sometimes it does happen. I'll give you a perfect example. Let's say you have a brother-in-law. Maybe you do, I don't know. And he dies in a car accident. He, died today in a car accident, and your sister, his wife, you've got 3 kids and never had any life insurance. Now you can bet you and your family are going to look into getting life insurance. And sometimes, unfortunately, people really step up to the plate when bad things happen.
Yeah. Understood. We're covering a lot here. What haven't we covered? What are some things that come to mind for you that just in general, retirement or, maybe anything else that we've talked thus far that maybe we need to elaborate a little bit more, or anything else that you feel is important that we've got to give the audience?
So I think, taxes have been a big issue. And, I've always believed because COVID, the Ukraine war, all the money our government's spending, that taxes are going to go up. Now, because Trump's new big, beautiful bill, the tax brackets are supposed to stay the same. But we know that we have midterm elections every 2 years and laws change. So there's no guarantee that our tax brackets are going to stay the same. But the thing that a lot of people aren't talking about is some things are going up because we account for inflation about 2.5%, somewhere in that range. But some things are going up double that, like college, long-term care, housing costs, healthcare costs. And these are things that people aren't thinking about, but they need to. And we need to address that in their retirement plan. Some of the other things is people don't realize there's a big difference between their working years and when they're retired. So when they're working, they're getting a paycheck, they're paying taxes, they're putting into their 401k, and they have subsidized life insurance, health insurance from their employer. Now it all changes when they go to retire. A lot of people's mindset is, oh, I'm done. But you're not done, because now you have another 20 or 30 years in retirement. And the thing is, they're not understanding is when you retire, the paycheck stops, right? And now they're pulling money from their retirement accounts. Mm-hmm. They got to pay taxes. They got to deal with RMDs we talked about. Yeah. They got to deal with the IRMAA penalty, which is what I talked about for Medicare penalties. They got to deal with that. They got to deal with Social Security. They got to deal with market crashes. They got to deal with long-term care. So it's way different on the side that I deal with, what I call the retirement red zone. Some people it'll vary, but 5 years before and 5 years after retirement. And if you're not understanding there's a difference between before and the retirement red zone and retirement, people need to understand that because of all the things that changes. It's kind of scary. There's no paycheck anymore.
Yeah.
You got to pull for your retirement accounts. You have to worry about outliving your money. Yep. And so you really have to plan for that. People have to understand that And the other thing too is there's different tax buckets. What I try and explain to clients is you've got your tax now, which is your anything you get paid on your paycheck, put money in the bank, a brokerage account, a CD, a money market. You get taxed on that again. And so I recommend just putting your emergency money there. And then you have, your taxed accounts, which are taxed later, right? Which is pension plans, IRAs, 401ks, TSPs. But I already mentioned the big tax trap there, that they're going to have taxes down the road.
Yep.
And the third one that a lot of advisors don't use that I like is either the Roth IRA or cash value life insurance. Now those are after tax dollars, and they're tax-free dollars. So, we've heard our whole life you don't want to put all your eggs in one basket.
Right.
So I try and explain to clients, let's move, keep what you need in your emergency account. We need to maybe stop putting so much money into that IRA 401k, and let's put in some to the Roth or the tax the cash value life insurance, so you can have that tax-free income, reduce taxes in the future. And so there's all these things that we can teach clients, but the more we teach them, the more they understand, the more they get it, why it's so important to have all this planning done.
Yeah, absolutely. Roth conversion, real quick. Can you just highlight that real quick?
Sure. So one thing I was going to add in, I forgot, was not all money is taxed the same. So need to understand how to pull money from retirement accounts in the most efficient way.
Yeah.
Going back to those tax later accounts, the pension plans, IRAs, stuff like that. What the Roth is a strategy. So let's say someone has $2 million in their IRA, right? And in their 401k. Let's say they've got $2 million in there, and at whatever age they are, they're going to have to either pull RMDs at 70.5, 73, or 75. And at $2 million, it's like 4% that they'd have to pull. So, that's like almost getting close to $100,000 that they have to pull in RMDs. If they convert some of that money to a Roth account, they pay the tax now. So let's just say they take half of it, $500,000. They pay the tax on it. And some of these accounts that we can move into have big bonuses, like 23, 24% bonus. So if someone's going to move $500,000 into a Roth and pay, let's say, $100,000 in tax, we could cover almost all of it with these products.
These bonuses.
Yeah. And so now once they convert it and it's converted, now they never have to pay tax again. They can leave it as a legacy if they want, and then they're not liable to have to pay RMDs on it later.
Right.
So it can be a good conversion strategy to reduce taxes in the future.
Those bonuses there, are they only to be utilized to pay the tax, or can you use it for other purposes, or can it just be part of the face value of the account?
So that's an annuity product.
Okay.
So it could be if, like, let's say someone's in a bad investment. Could be a bad annuity. There's good annuities, bad annuities. But let's just say they have money in an account that hasn't performed well. They haven't made much money on it, and maybe there is a penalty to get out of it. If it's an incentive when they move that money, because no one wants to take, whatever the amount of money is, and let's say it's $250,000, and now they got to pay a $20,000 penalty. Nobody wants to pay that. But if they can move that money into something better, maybe with some guarantees or whatever, and we can cover all those penalties, that's why they have that in place to allow people to get out of a bad investment and get into something better.
I see. Okay. Anything else come to mind, Gerard? I mean, I know
we talked about a lot.
All over the place. A lot of great practical tips, but anything else coming to mind that we need to
we should
discuss?
I had fun. We should do this more often.
Well, we definitely will do this.
Topics.
Yeah, no, we'll definitely do this more often. Obviously, very importantly, is how do people find you? How do people work with you? And maybe if they are thinking about reaching out to you, what is your process for consulting and just, initially, walking them through what you can do for them?
So they can reach out. I usually give people my cell phone.
Okay.
It's 949-306-0353.
Okay.
They can go on my website, legacyfinanciallv.com. They can go there. Usually the process is just having a conversation. I want to see what the client is looking to do. And one of the first things I learned is ask them what they're calling about. Because I've had clients sometimes call and like after a 5-minute conversation, like, oh, you want Medicare insurance? Like, I don't do Medicare, right? And so I want to make sure that whatever they're looking for, we don't waste each other's time. So that's the first thing. And so once I establish that and see what they're looking to do, if it's something I can help them, then we'll have a quick conversation about it. Schedule an appointment where we can either get on a phone call or get on a Zoom, depending on if it's something I want to educate them about, and then just go for there. And then from once realize that we want to work with each other, because it's a two-way street, right? I've had clients before where I don't like to work with. And a perfect example is I work with business owners and I help them with employee retention, taxes, growing their business. And I have all these experts that can help with that. And every once in a while, I get a business owner that doesn't care at all about his employees, right? All he wants is the best for him and crap for the employees.
Yeah.
I don't like working with someone like that. I tell them, you realize you don't have a business without your employees, and it's a preference thing. It's got to be a thing we can work together and make sure we're on the same page. But once we establish that, then I will go into taking a detailed account of all their finances. I call GPS, their goals, and everything that they want to do, their passions, their struggles, and figure all that out. And then then what I have to determine is, are we on the same path? What I find out a lot is, people put into their 401ks and stuff. And think about that. When you go work for a company, and most people do this, they start filling out their 401k paperwork and they don't know anything about it, majority of them.
Yep.
And then they go up to the HR person, hey, can you help? And they're like, by law, I can't recommend anything. I'm sorry.
Yep.
So what they do, they go, oh, geez, I got to get back. Yeah. They start just filling stuff out. And they never really manage it. And the problem is now these people are not managing their money and they really need help doing it.
Yeah.
They need a professional to help them do that.
Yeah, absolutely. Yeah. And with that being said, I mean, even individuals who, have 401ks at other companies and may not think that someone like you can help them, you obviously can, right?
Yeah, so that's a great point. Thank you for bringing that up. When people are still working and they're 59 and a half, they can do what's called a in-service rollover. So probably about 85% of the time, their company will allow them to take some of that 401k money and we can roll it into an IRA. They don't lose the tax advantage, so still tax deferred.
Yep.
0 fees, 0 penalties, 0 cost. We roll it into the IRA, and the reason they'd want to do that is so they can protect some of that money so it's there for retirement. Like, think about all the people today that are 59 and a half and older, and they're still working, and they're absolutely terrified that another 2008 is going to happen, right?
Yep.
But they don't know what to do. They don't know that there's all these different products and services that they can help educate them and maybe even move their money into something secure where they can't lose their money.
Right.
So that's a big thing. Yeah. So that's a huge thing for people. And the other thing is, the generations before us typically worked for a company for 30 years. Our generation below, I don't know what the stats are, but it's something like the average will have 8 to 10 jobs in their lifetime.
Yeah.
And a lot of people have old 401ks that are, they're back at the company they used to work at, and they kind of just forget about it. Well, they don't know that they can I can help them roll that over into an IRA and keep it secure, because if it's still with that company and a lot of it's in the market or company stock and that company goes bad, they lose everything.
Yeah.
Where if we roll it into an IRA, like I said, no penalties, no fees, we can roll that over and they can protect that money. So that's a big opportunity too.
Great point. Great point. Well, this has been incredibly helpful, Gerard. We covered a lot. I want to thank you for coming on today, sharing your expertise, and certainly everyone here. You've heard how to get in touch with Gerard. It's not just about investments, but strategy, education. Number one, first and foremost, what I'm hearing is there's, as you opened up, there's this lack of education, and as a result, because of all these moving parts, it could literally be a domino effect in retirement if people aren't adequately educated, prepared, guided, by the right people. So I want to thank you for coming on today. For the audience, you've got Gerard's information. Feel free to reach out to him to talk more about all the different topics that we talked about, and we talked about a lot today. Certainly, you can always reach out to me as well, and I can put you in touch with Gerard. And as always, if there's questions about housing wealth and how housing wealth can be incorporated into some of these strategies, even some of the topics that Gerard talked about that maybe could be a solution to help increase liquidity or further grow net assets or even decrease income taxes, reach out to me anytime. Happy to be a resource. As always, thanks for tuning in here to Retirement with Rick, the show that talks all about retirement and how to make your life more successful, more enjoyable. Until the next one.